Did you miss me? Of course you did. Come here. Let's talk stock market. So everybody that invests in the stock market is likely playing a different game than you are. I am playing a different game than you are. Everybody that is investing is probably playing a different game than you are. And that's why if you listen to everybody's advice and take their advice step by step, it's likely that you're going to remain poor because you're not playing the same game. Let me explain. So while there are many ways to make money on the stock market, I'm going to put that into 4 different categories. And inside these categories, people invest in different ways also. But just to make it easier, let's talk about the 4 main ways that people invest in the stock market. We have the trader who likes to open and close trades within that same day, maybe a week. We have the short-term investor who likes to hold maybe 3 months, maybe 6 months, maybe even a year. And we have the long-term investor who's looking at 5, 10 years plus. And we have a dividend investor, me, whose main goal is to increase cash flow so I can live a great lifestyle. Now, all of these investors have different ways that they're going to invest and different things that they focus on. So out of these 4 different investors, who is going to be most concerned about volatility? Our trader friend is probably going to love volatility, especially if the market is moving up, because they get to jump in and jump out of trades really quickly and can make money that way. That's their game. Do you think that they're going to be concerned about dividends? Not at all. They couldn't care less. They're looking for companies that are volatile, highly liquid, so they can get in and out quickly, and especially ones that are in the media that people are talking about, because those are the companies that other investors might jump on, and the trader is going to take advantage of that. That's the game they're playing. Next, we've got the short-term investor who's investing for a few months to maybe a year. They are also concerned with volatility, probably the most out of all of the other brackets. Are most concerned about volatility. They're usually the people that also, if they think there's a recession around the corner, they're going to pull their money out and put it into cash, say, because they're very worried about price in that instance. But mostly they're looking for short-term gains. And again, they don't really care about dividends that much. If they get them, that's a bonus, but they're not concerned at all. And that's not their criteria for choosing stocks. We have the long-term investor. Not so much concerned about volatility. They know that the market is going to go up over the long term. Because it does. Now, the long-term investor is going to be very concerned more about what the company does, their fundamentals, whether they're a stable company, and whether they have growth over the long term. They probably also like dividends, but they're not primarily focused on that. They might just have a few dividend stocks in their portfolio for diversification. But mostly they're looking for strong, stable companies, probably those in the ASX 200, but definitely those big, stable companies that are going to be around for a long time. They're not interested in short-term market fluctuations because they have a long-term horizon. Then we have the dividend investor. For me, I'm mainly concerned about getting a high, good dividend that's going to increase over time. I'm less concerned about price, and I really don't care once I hold a company what the price does. I really don't care. As long as the dividends are going up over the long term and I'm getting a really good return on my money. So the only time I really care about price is when I'm buying, because I like to lock in a lower price so that my yield is better when I first get into a company, but I'm less concerned once it goes on. I could theoretically be fine with holding a company that pays me a 10, 12% dividend for the rest of my life if the price kept falling and falling and falling and loses 50 or more percent of its value. I don't care because I'm not going to sell that stock. I'm there for the income. Now, sure, my ego will get a hit if the price goes down and my portfolio looks smaller than it did yesterday, but it's not going to affect my income whatsoever, so I don't really care. So when people come in and they write comments like, this particular company that you recommended, that you like, has fallen 10%, 15%, I don't care. I'm not selling, so I'm not going to lock in a loss. I only care if they don't continue to pay dividends. Now, I know what you're going to say. You're going to say, but why would you want a company that falls in price? Look, let's be real. If a company is in trouble and the stock price is falling, usually they're going to cut the dividend well before that time anyway. I know you've heard of dividend traps. They're not really as common as you think. And because I'm looking for dividend consistency, I can usually see a one-off high dividend a mile away. I'm looking for dividend consistency that they've paid high dividends over the long term. That is my game, and that is what I'm concerned with. Don't care so much about price. Now, within all 4 of these areas, there are other ways to make money as well. You can short a stock, you can write options. There are so many different ways you can play the stock market game. There isn't just one way. But what you've got to figure out is what your game is and how you're playing. And that's going to be different for every single person. And you also need to work out what your risk profile is Every single person watching is probably going to have a different amount of risk that they're willing to take in the stock market. Some people, especially traders, don't mind taking a bigger risk, and others like to play it safe and only invest in, say, ETFs. And that is perfectly fine. You need to figure out what your risk is. Also, let's talk about how much money you have to put into the market, because that is also going to change significantly how you play the game. Now, for me as a dividend investor, I can afford to not care about things because I have quite a substantial amount of money in the stock market, so I can live off the dividends. But if you say have $10,000, you're not going to have enough to live off the dividends that way, so you're going to be playing a completely different game than I am. And that's fine. That's not to say that you can't be a dividend investor with a small amount of money. That just means you're starting at a different level and you might make different decisions that I might make. The decisions I make and the decisions you make are going to be completely dependent on what our game is, what our rules are, and how we like to play the game. We all like to play this game better, and I do think it's a game. I know investing is serious business, but I kind of do see it like a game that I want to win. Also, your age is also going to be a huge factor in how you play the game. So someone younger who's just entered the workforce, they're going to be able to take a few more risks. They're going to be able to play around a lot more than someone who's closer to retirement age, who needs to keep that cash pretty safe so that they know how much that they can retire on and how much money that they have. Those two people have different goals and different ways that they'll probably invest. All of these people can make money. The problem lies when someone, say, from long-term investing sees someone who's talking about short-term investing or trading, so they start to think about doing something different than they normally would do. This happens a lot when the market is very volatile, especially when it's falling. They might be persuaded to sell something that they normally wouldn't have sold anyway because everybody else is doing it, all the traders are making money. This could be because a lot of people are hyping up a particular way to invest or a particular asset class that they're not comfortable with. You've got to remember, listening to noise, listening to other creators can be a great way to learn, but you need to be strong in your own convictions on how you invest, how you choose to spend your money within the stock market, how you play the game. You need to have those nerves of steel when the market goes up and down, because other people who are jumping in and out of the market might be playing a different game than you. They could be making money, they might not. All this to say, figure out what your goals are, what your investment style is, and stop being persuaded by people that are not playing the same game as you. If you're young, take time and try a few things out, see what fits best for you, and that way you can stick with something that you know and like doing. But don't always follow what every single other person is doing, because they likely have a different amount of money that they're investing. They might have a different time frame that they're investing. They definitely probably have a different style and strategy than you. It's so important that we know what our own game in the stock market is, that we're confident in the strategies that we're doing. And if it doesn't work, that's fine. You can adjust as you go along. You can change things up if they're not working. But just blindly jumping on trends and following other people is not going to make you the millionaire that you think it is. You need to find your own game. And I know you can do it because I read your comments and everybody is so super smart, except the people that keep telling me that the price is going down and they're going to put their money in cash. And I'm like, yeah, I'm not going to do that. I'll keep cashing those dividend checks. Thanks. Anyway, I'll see you in the next video. Take care. Bye.